Hi, my name is Mary Willis, and I will explain why, in our Birkenroad report, Jay Roberts, Ross Lara, and I give Hornbeck Offshore a market outperform rating with a 12-month target price of $26, and why Hornbeck Offshore sets its course by the stars, not by the lights of passing ships. Our 12-month price target and market outperform rating takes into account the recent downturn in the oil and gas industry. Recently, during the fourth quarter earnings call, the company offered a sobering assessment of the Gulf of Mexico offshore supply market. Management conceded that a dilapidated shelf market, coupled with lower prices, has pressured the day rates and utilization of Hornbeck's offshore supply vessels. You can see from this graph how closely related Hornbeck's stock price and the WTI crude price is. The next graph clearly shows that the drop in Hornbeck's price-to-book value ratio is due to the current downturn in the oil industry. In June 2014, before the drop in oil prices, Hornbeck was trading at $45.46, or approximately 120% of its price-to-book value. Hornbeck's stock in mid-March of this year was trading at around $19, or nearly 50% of its price-to-book value, just to compare. We believe that Hornbeck has high-quality assets, and its price-to-book value will rise in conjunction with oil prices. Therefore, we consider the current stock price as an attractive entry point for investors who are interested in longer-term returns. Before I delve into our investment thesis, a brief overview of Hornbeck for those who are unfamiliar with the business. Hornbeck is a provider of marine transportation services to offshore oil and gas exploration and production, offshore construction, and U.S. military customers around the globe. It operates a fleet of 64 new generation, technologically advanced offshore supply vessels called OSVs and multi-purpose support vessels called MPSVs. It operates mainly in Mexico, Brazil, and the Gulf of Mexico, and its customer base spans the spectrum of the oil and gas industry, from independent E&P companies to majors to national oil companies. Moving to our investment thesis, our team expects utilization and day rates to drop in all core operating areas, and the supply and demand gap of offshore supply vessels in the Gulf of Mexico to widen this year, creating further pricing pressure for E&P customers. Our team believes that whether the oil price collapse is U-shaped or V-shaped, management has positioned the company for success once commodity prices rise. A high-graded fleet, an attractive capital structure, and substantial free cash flow by 2016 will allow Hornbeck to weather the storm. The company has already stacked 12 new generation vessels, consisting of both low-spec and high-spec vessels, in order to maximize the opportunity for its ultra-high-spec Hosmac vessels to maintain utilization. Management's proactive decision to stack vessels is prudent in an oversupplied market and reflects management's commitment to maintain margins. An oversupply of OSVs in the Gulf of Mexico will continue to create a soft market for these vessels in 2015. More high-spec OSVs are expected to arrive in the region during the year, with management saying that roughly 160 high-spec vessels currently operate in the Gulf of Mexico now, and that the number will increase to 200 when the year ends. Few additions, though, are slated for 2016. Thus, when deepwater demand accelerates and the rig count rises to a healthy level, the OSV market supply and demand gap will likely close. Hornbeck considers 50 deepwater rigs actively drilling in the Gulf of Mexico as healthy demand for its high-spec fleet. As of the end of February, the deepwater rig count was 44. While 8 contracted rigs are expected to come online this year, the exact timing remains unclear. More troubling, 10 rigs are rolling off contract, and exploration companies will likely press those rig owners for cheaper rates. Due to the falling rig count and pricing pressure from customers, we expect utilization and day rates to drop for the company's OSVs. and this includes the international market, even though the offshore market utilization rate has not fallen so steeply in Mexico and Brazil. A number of Hornbeck's vessels are coming off of contracts and could have greater idle time due to Pemex's recent budget cuts and Petrobras' corruption scandal. Since the start of the company, the management team has followed U.S. General Omar Bradley's famous adage, "Set your course by the stars, not by the lights of every passing ship." Hornbeck strives to jump on technological and demand trends before its competitors. Looking at rig build orders years down the road, management has successfully timed its own new build programs to take advantage of increasing offshore capital expenditures and the increasing percentage of capital expenditures allocated to deep water activity. As shown in the next figure, Hornbeck's fleet composition will consist of more 300 class vessels and more MPSVs by 2016, which will accommodate clients drilling in deep water activity. These vessels have more deadweight tonnage, and the MPSVs are designed for deep water subsea operations and can carry cranes, reel systems, and remotely operated vehicles. In addition to a high-graded fleet, Hornbeck has a favorable capital structure, as the company recently extended the maturity and amended the covenants of its $300 million revolving credit facility, which reflects a vote of confidence by energy lenders. Hornbeck has greater financial flexibility than some of its peers during this down cycle. The current ratio, generally greater than 2 times, represents a company that is in good financial health, while anything under this benchmark is considered risky. The current ratio of 4.6 times indicates that Hornbeck is in a better financial standing than its peers, with an average current ratio of 2.2 times. In terms of cash flow, the company will have a significant amount by 2016, since the company's new build program is almost complete. The company will also receive a cash injection from its recent sale of vessels to the U.S. Navy, which totaled $114 million. Hornbeck faces the following near-term risks: commodity price weakness, shipbuilding delays, pricing pressure from customers, low rig count, and probably most importantly, offshore project delays, which would push out the production curve for the Gulf of Mexico. Looking at shareholder activity in the last 6 months, mutual fund managers and investment advisors decreased their position by almost 2 million shares. We believe this change is mainly due to the price collapse over the last 8 months, as those types of investors are less able to weather a share price decline. Hedge funds and private equity firms, though, bought more shares, which we believe is a positive sign that Hornbeck's stock is near its bottom and will rebound in the future. Hedge funds and private equity firms usually like to buy stocks trading below their net book and intrinsic value. These firms also have longer time frames for generating returns and sufficient capital to wait for a price rebound than other investors. Finally, our valuation. Our team utilized a weighted average of discounted cash flow and relative multiple methods to arrive at our 12-month target price of $26. This target price translates to a 1-year return of about 28%. The DCF method utilized free cash flow projections based on our extensive modeling process, and the relative multiple method leveraged industry standard financial ratios in order to determine a projected stock price. In conclusion, even though the length and extent of the downturn remains uncertain, we believe that Hornbeck will outperform its peers in the offshore transportation oil services sector due to the company's high-quality assets and strong balance sheet. Further, we believe that, in contrast to the current year, 2016 will bode better for Hornbeck as it returns to more typical trading ranges.